Hello everyone and welcome back to the part 5 of this financial modeling series in which we are building the financial model of Bharti Airtel Limited. So basically in the previous parts we have built the revenue assumptions, we have completed the expenses assumption, depreciation, amortization schedule and all. So if you haven't watched that particular parts of this financial modeling series, please do watch that before watching this video. So basically in this video, we are going to build the balance sheet drivers of Bharti Airtel Limited, in which we are going to forecast accounts receivable, accounts payable and inventory. Okay, so moving forward, let's start formatting our Excel sheet. The first thing we need to do is we need to remove the grid lines and reduce the size of this particular column. So let's copy this and paste it here. The first thing we have is accounts receivable. So how we are going to forecast the accounts receivable? The right method to forecast the accounts receivable is to calculate the day sales outstanding. So what is day sales outstanding? Day sales outstanding basically represents the number of days in which the company is able to convert its debtors into cash. Okay, as simple as that. And the formula to calculate the day sales outstanding is it's average receivables upon my credit sales into 365. That is basically the number of days in a year. But here we don't have the required data. We have accounts receivable, but we don't have net credit sales. So in our case, in this particular case, we will be using uh, total revenue to forecast the accounts receivable. So basically we will take accounts receivable as a percentage of total revenue, and on the basis of that percentage we will forecast accounts receivable for the projected years, that is from fiscal year 23 to 27. So let's start doing that as a percentage of total revenue. So first of all, let's link the accounts receivable from the balance sheet. Under balance sheet, we have current assets, and under current assets, we have trade receivables, which is also known as accounts receivable. So now let's calculate the percentage. Move to the revenue assumptions. Under that, we have total revenue from operations. Oh, got it? Alt H VSF. So let's convert this into percentage. Okay. We have basically link this from here. Okay. So let's give a formatting here. Change the color. Alt H BA. Let's calculate the average. The average is coming out to be 4.95%. So let's copy this till the very end and calculate the accounts receivable by multiplying this percentage by the revenue from operations, or the total revenue for the upcoming years. Okay, so basically we have forecasted the accounts receivable for the upcoming years, that is from fiscal year 23 to 27. The next thing we need to forecast is accounts payable. Okay, so yeah, the right method to forecast the accounts payable whenever the required information is available is to calculate the days payable outstanding. So basically, what do we mean by day payables outstanding? Day payables outstanding basically means in how many days the company is able to pay the amount to its creditors, which they basically owes to them. Then the formula to calculate the day payables outstanding is the average accounts payable divided by the cost of goods sold. But in our case, Airtel is basically a service based company in which we do not have cost of goods sold. Okay, so in our case, we will basically forecast accounts payable as a percentage of operating expenses. Okay, as a percentage of operating expenses. So let's link the accounts payable from balance sheet, and we can find this under the current assets. Here we have trade payables, which is also known as accounts payable. Okay, and now let's calculate this. Let's divide this by operating expenses, and we can find the operating expenses under the head of income statement. Under the income statement we have expenses, and under the expenses the first thing we have is total operating expenses. So press enter, and we have our percentage with us. After this we have to do one thing. Let's forecast these expenses. First, let's forecast these expenses. Let's move to the expense assumption sheet under which we have calculated all the expenses. So let's copy this. Same with the access charges. Move to the expenses assumption, access charges, press enter, drag it till the very end. Then we have license and spectrum fees. Move to the expenses assumptions only, license and spectrum fees, drag it till the very end. Same for the employee benefit expenses. Move to the expenses assumption. Here we have the employee benefit expenses, drag it till the very end. Then we have expenses assumption, which is sales and marketing expenses, other expenses. Okay, here we go. Now let's drag this formula till the very end. Okay, now we have our total operating expenses for the forecasted years as well. Now let's forecast the accounts payable for the upcoming years. First copy this and paste it here. Okay, change this into percentage only. Let's take out the average. The average is coming out to be 49.62. Let's copy this till the very end, change this into percentage, and after this equals to, as a percentage of operating expenses multiplied by the total operating expenses, and total operating expenses are present under the income statement. And let's take this for the forecasted years. Okay, so moving forward, the next thing we have is inventory. And how we basically forecast inventory is, the first thing we need to do is we need to calculate days inventory outstanding. And what do we mean by days inventory outstanding? It basically means how much time or the days company takes to convert its inventory into sales. But here we don't have so first of all, the formula to calculate the days inventory outstanding is average inventory divided by the cost of goods sold multiplied by 365 days. But in our case, we don't have information related to cost of goods sold because this is a service based company. So what we have to do is we just have to calculate the inventory for the forecasted year by considering as a percentage of operating expenses. So let's take and as a percentage of operating expenses. It's as simple as that. Let's link the inventory, and inventory is present inside the balance sheet under current assets. Copy this till the very end, and after this press equals to, select the inventory, move to the income statement. Under income statement, you have total operating expenses. Copy this till the very end. Change this into percentage. As simple as that. Copy this, formatting here. Take out the average. Close the bracket, and the average is coming out to be 0.34. Okay. So next thing we have to do is equals to take this percentage and multiply it by the total operating expenses, which is available in the income statement. And in this way, we can forecast the inventory. So we are done with the forecasting of the balance sheet items, three major items, that is accounts receivable, accounts payable, and the inventory. So first of all, let's complete the formatting of this as well. So in this video, that's it. We have basically forecasted the balance sheet assumptions. And if you guys have any doubts, please feel free to reach out, and we will be more than happy to solve your doubts. Thank you so much for watching this video.